Coming up, why one Australian bank CEO thinks Australia will avoid a recession, the Australian share market finally rises, and property price growth eases. All of that and more next. Hi everyone, welcome to the SBS On the Money podcast for this Friday, the 1st of May 2026. It's a day where the Australian share market finally rose. We'll have the details with Lochlan Halloway from Morningstar in a few moments. Plus, we take a look at why one expert says we're at the start of what could be a downturn in Australia's property market. If you're new to the podcast, welcome. We go into more detail of the top consumer finance and market news stories covered during On the Money on SBS World News. But first, the CEO of ANZ, Nuno Matos, has told investors he expects Australia will avoid a recession despite ongoing global uncertainty. That's as the bank posted a $3.8 billion half-year cash profit, up 70% on the previous 6 months as it transforms and simplifies its business. It'll pay an 83-cent per share interim dividend. That's steady on the same period last year. Here is some of what he had to say earlier today about the state of the global and local economies.
As Australia's most international bank, we have a front row seat to global developments. The real impact of this crisis remains ahead of us, with the physical flow of critical commodities from the Middle East being key. While we have made a small downward adjustment to our global GDP forecast, at this stage, we'll still see the global economy growing at around 3.2% this year. In Australia, consumer and business confidence is materially weaker. However, spending and business conditions have only impacted modestly so far, and employment growth is stable. This supports our central expectation that Australia will avoid a recession. Although the situation is extremely dynamic and we are prepared for a range of outcomes. The longer the flow of oil is constrained, the greater the chance the crisis shifts from being primarily an inflation challenge to more of a supply and growth challenge with greater economic impact.
That's Nuno Matos, the CEO of ANZ, and shares in the bank still fell 3% today, or nearly 3%, although they are up more than 20% since Mr. Matos assumed the role of CEO nearly a year ago. Meanwhile, Coles says it has already lifted prices for meat, dairy and fresh produce as suppliers ask the supermarket giant to increase shelf prices to offset higher fuel costs. It says packaged food may be next, even if it tries to absorb some rising costs. It hasn't stopped shoppers so far. The company lifted supermarket sales to nearly $10 billion in the third quarter of this financial year. That's up 4% on the same time last year. Supermarket prices, excluding tobacco, rose just 0.8% at Coles, down from 1.1% the same quarter a year ago, while they fell at rival Woolies. Coles shares climbed 3.7% today. So let's take a closer look at the Australian share market, which finally rose today, driven by the materials sector, namely BHP. The ASX 200 up 0.8%, ending its longest losing streak since 2018. Remember, it closed lower for 8 sessions in a row, which means since the 1st of April, the index rose 0.7%, but it's underperformed US shares, where the S&P 500 soared nearly 10% over the same period. Investors taking a liking to recent tech earnings from Google, owner Alphabet and Amazon, for example. Back to today, though, some took comfort from an easing oil price, which tumbled 10% compared to this time yesterday at around $111 a barrel. It did rise 11% in the previous session, though. And for a closer look at the day's market action, I spoke with Morningstar equity market strategist Lochlan Halloway. Lochlan, shares are up today. What's driving investor sentiment overall? Because we've got this ongoing global uncertainty where the oil price is remaining high, yet the US markets, they're breaking records as company earnings come out.
Yeah, well, there's really two big narratives right now driving global markets. One, as you point out, is of course the ongoing Iran conflict and the closure of the Strait of Hormuz. That is not good news for the real economy or businesses in general, unless you're an energy producer. And that is clearly a threat and it's not good news. But on the other hand, you've got this AI story and particularly AI infrastructure right now. You know, the chip makers of the world and what we call the hyperscalers, the big tech companies that are selling computing power. And their results are coming out and they're pretty strong and they're growing quickly. There's questions down the road about monetization, but right now there's enough there to keep markets generally buoyant, particularly in the US, which is offsetting the obvious risks from the Iran conflict.
But isn't the war having an impact on local company earnings and their earning outlook?
It certainly is. And we've seen a number of trading updates and profit warnings from local companies in the last few weeks, talking to exactly that point, that the fuel price shock and the shock to demand and consumer sentiment is having an impact and is expected to have an impact in the months ahead. And when we look at Australian equities and the performance of Australian equities since the conflict, it looks quite different to US equities because we don't have that AI story here like they do. If anything, most tech companies on the ASX are seen as potentially vulnerable to disruption from AI. If you think about the WiseTechs and Zeros and the technology ones on our index, which have been really, really punished by investors in the last few months because of disruption fears. So we don't have any of that AI story to keep equity prices supported. And that's why our market has underperformed versus US equities in the last few weeks.
So we've spoken about the war and oil prices. We've spoken about AI. What about global interest rates? Because we know the central banks of the US, the UK, ECB, Canada, Japan, they all met this week. They held rates. The RBA is expected to meet next week and is expected to lift interest rates, unlike the other major global central banks. Why? And what does that mean for markets?
Yes, the RBA is, I suppose, in a different part of the cycle. It seems a bit out of kilter with most other central banks in that it's already raised rates twice, and next week looks very likely that they'll raise again. Look, what's really driving the story here in Australia is that we have a big productivity problem. Labour productivity is growing so slowly that even a very modest rise in demand, the economy is running into supply constraints, and when there's too much demand and not enough supply, that pushes up prices. And so even without the oil shock and the energy fuel shock, which is inflationary, there was still a reason for the RBA to be tightening. And if that fuel shock went away tomorrow, I expect that there still would be cause there to tighten rates because of this underlying productivity problem. Now, abroad, we're not seeing at least the same hiking yet, though it is worth noting that in the US, yes, the Federal Reserve held rates, but markets have now written off basically the chance of any further cuts this year. Markets have been expecting cuts only a few months ago. Now they've said no more cuts because of this oil price shock and also the tariffs. And in fact, markets think now maybe a hike might be the next move up for the Federal Reserve. So globally, interest rate expectations are rising. The RBA is actively hiking here, but interest rate expectations globally are moving upwards.
Okay, with market volatility, do you expect there to be more merger and acquisition activity to come? Because in the past week, we've seen offers for toll road operator Atlas Arteria, outdoor media company Media. Who's next?
Well, it was very hard to predict the ebbs and flows of M&A. What I would say is that private capital seems to be taking this opportunity of skittishness in public markets to buy up some businesses on the cheap. We saw that hostile bid for Atlas this week and Media as well. Look, I suppose public markets, they are jittery, and in a lot of those businesses, the two I just mentioned, markets, public investors have largely thrown in the towel and given up. Private capital said, look, we can stomach the short-term volatility. We'll take the business privately. We'll ride that out, and we'll try and get the turnaround story that we think is possible there. That is, I suppose, private capital's gain if they're willing to be long-term investors. Unfortunately, though, we're not seeing equivalently more companies coming back to public markets, through IPOs, which have been very soft recently, which is, generally a shame for public market investors because the opportunity set is shrinking, and that's not good news. And I suppose the rate of exits is not being matched commensurately by the rate of new companies coming to the bourse, which is a shame.
So finally, what are you telling your clients right now, and where do you see the opportunities for investors?
Yeah, look, I think as always through these shocks, these geopolitical events like the Iran conflict, staying the course is important and not getting tempted to try and trade around the news cycle if you're a long-term investor, like we are. It can be an opportunity, of course, to buy up businesses that have been unduly oversold, and you can see private markets doing that right now with some of the businesses like Atlas and Media. So you can perhaps use it to your advantage like that, but not trying to trade in and out of the very short-term stuff. Will Trump open up the strait tomorrow or won't he? That sort of stuff I don't think is great fodder for long-term investors. We do see a lot of opportunities coming up though as a result of this sell-off and other concerns around AI disruption. I mentioned a few of the tech names a few minutes ago on the ASX, like WiseTech and Xero, for example, which look like great value to us. They look like much higher quality businesses than your average tech company. Yes, AI is going to be enormous. It will change businesses. It will be existential for some businesses, but the better quality software businesses look better insulated from that. And so we see opportunities there for investors to take a closer look at some of those undervalued tech stocks on our index.
That's Lochlan Halloway there from Morningstar. Now, while the markets here bet the RBA will push ahead with another interest rate rise on Tuesday to tackle increasing inflation, it would appear it's contributing to a fall in property values in Australia's two biggest markets. Cotality says both Sydney and Melbourne saw prices tumble 0.6% in March, and of the capitals, Perth and Darwin performed best. But it means the national median price rose just 0.3% to around $940,000, meaning we're seeing slower growth. For more, I spoke with Cotality's head of research, Tim Lawless, who told me this could be the start of a downturn. Tim, how would you describe the pace of property price growth at the moment and what's driving it?
Well, in a phrase, rising but slowing. We saw our national index up by 0.3% in April. If you go back to October last year, which looks like the peak rate of growth, we're seeing our national index rising at about 1.2% month on month. Now it's slowed back to 0.3%. That's the slowest monthly rate we've seen since January last year, which of course was the month just prior to interest rates starting to come down, which they did 3 times last year. And the market's also really diverse. We're seeing everywhere from, say, Perth rising at 2.1% month on month to Sydney and Melbourne, which are now in their 5th month of declines, where values are falling by 0.6% month on month.
How are buyers feeling at the moment?
Well, I think buyers are probably in this space of feeling a bit more empowered because there's more stock, so there's more choice, there's less urgency in the marketplace. But also we've seen consumer confidence and sentiment has absolutely fallen off a cliff. So I think for a lot of buyers, they're probably also waiting in the wings to see, well, how far are housing prices going to fall? How much are interest rates going to rise? And what do their household balance sheets look like? So I think we can definitely say there's some significant demand side headwinds building here in Australia. They were already present before interest rates rose by 50 basis points and the oil crisis emerged. But now we're in a situation where interest rates are likely to rise further and sentiment is absolutely at the bottom of a cliff at the moment.
Have you seen a shift in the way stock is being sold? For example, what are auction clearance rates like? Are there more sales before auction? Are there more private treaties?
Yeah, absolutely. We're seeing clearance rates holding very low. They've been holding in the low to mid 50% range pretty much since the end of March. So a long run average for auction clearance rates is about 66%. So to see clearance rates around that low 50% range persistently really does highlight there's been a fundamental shift in the selling dynamic. It's no longer a seller's market, particularly in Sydney and Melbourne where values are falling and where stock levels are now above average. We're not necessarily seeing a shift in the way homes are being sold just yet, but you'd have to expect as clearance rates hold low, we probably will see more vendors wondering if auctions are the most relevant way to sell a property, especially given auctions work really well when there's a really competitive bidding environment, which doesn't seem to be the case at the moment.
You mentioned that it was a slowdown in terms of price growth, right? But in the two major markets of Sydney and Melbourne, we're seeing prices fall. Is this the start of a prolonged downturn?
Well, Sydney and Melbourne have been falling in value pretty much since peaking in November. So Sydney's down over 4 of the past 5 months. Melbourne's down consecutively in 5 months. So it does look like this is the start of a downturn. As to how long that's going to last is anybody's guess. I think there's a lot of uncertainty at the moment around the global economy and the domestic economy. There's some tax reform in the wings, it seems, as well, that could have an impact on housing markets. And we've got this pre-existing framework of severe affordability pressures and serviceability pressures as well. So it does look like the market's set for a further weakening from here. Sydney and Melbourne do tend to lead the cycles, and we are seeing a loss of momentum across the mid-sized capitals as well. But the wild card here, I think, Ricardo, is simply that supply does remain very low. And this is probably going to be one of the complexities going forward, is it's going to be a lot harder for builders and developers to deliver new supply against this backdrop of rising construction costs once again.
You mentioned potential tax changes. Can we explore that just briefly? As we head into the budget, there's talk about changes to capital gains tax, negative gearing rules. Is this feeding through to the market? How would any changes impact the market? And do you have a view as to the fairest way to tax property investment?
It's hard to know if this is feeding through to the market just yet. If you look at, say, lending data, which is probably the best clue, it's quite lagged. We're looking at December data at the moment. We can clearly see aggregate demand has fallen away. The number of home sales is lower now than it was a year ago, but that's not surprising given higher interest rates and low sentiment as well. So I think there's probably too many moving parts to isolate whether or not pending tax policy changes are having too much of an effect at the moment, but you'd have to think this is weighing on investor mindsets and probably delaying investment decisions until we see some certainty coming into the taxation framework. So put it this way, that it looks like, I mean, no one really knows what the changes are going to be at the moment, but it's likely we'll see some sort of a reduction in opportunities for capital gains tax concessions and less opportunity to negatively gear properties. So thinking about negative gearing for a moment, the typical yield on a property across Australia is around 3.2% gross, right? That's excluding holding costs. You've got mortgage rates for investors that are generally above 6%. So I think any opportunities that sort of preclude negative gearing are going to be quite impactful, given the fact that yields are so low and mortgage rates are quite high. There's a big spread between the two. If you can't offset your cash flow losses against your negative income, then I think that's going to be a real disincentive for investment in the marketplace. We may see that those sort of concessions geared more towards new properties, which I think is probably a logical tax incentive, trying to stimulate more housing supply from investors as well. And then we've got capital gains tax concessions, of course, which is the great unknown. Will it be grandfathered? Will it be a significant change or not? But again, I think investors are heavily motivated by opportunities for capital gain. It's one of the reasons why we see so much investment at a time when yields are so low. So you'd have to argue that less opportunity to realize a capital gain are also going to be either a disincentive for new investment or maybe an incentive for existing investors to hold their property for longer rather than realize or crystallize a capital gain.
And just finally, we spoke about the capital cities, right? What about the regional markets? Are they seeing as a significant slowdown?
Well, regional markets have been a lot more resilient. We haven't seen price growth slow as much as what we've seen across the capital cities. There has been a bit of a slowdown, but we're still seeing our combined regionals index up 0.9% over the month, outweighing the combined capitals, which is only 0.2% higher over the month. The difference is regional markets are now very much being powered along by some of the more rural markets. Areas like Toowoomba in Queensland, getting into markets like Wagga and Dubbo in New South Wales are very, very strong. The south of WA around Bunbury, Albany, to the north a little bit around Geraldton, also very strong markets. So it's no longer those regional lifestyle sea change or tree change markets that are really driving these trends like they were through the pandemic.
That's Tim Lawless from Cotality, and he wraps up the podcast for this Friday and for the week. Give it a like and a review. Don't forget to subscribe if you do enjoy it. And you can watch On the Money during the 6:30 weekday edition of SBS World News on SBS. The podcast returns on Monday. It drops after the market close every weekday. and I'll catch you then. This SBS On the Money podcast is provided for informational purposes only and should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decisions.